Hello everyone, I'm Ted Oakley, Managing Partner of Oxbow. I want to welcome you to our call, first quarter call actually, for year ending 22, beginning year 23. And if you look at some of the things that we think will be happening this year, we have a potential really for interest rates to peak. We have a potential for inflation to peak. If you notice, the high was during the summer. It's come down since that time. Now, don't confuse those two. We don't think they'll necessarily go to new lows, but they could well have been past the peak. Otherwise, we look for weaker economic news in the first and second quarter, third quarter maybe as well. It looks as though to us that we're just starting to get into the meat of what happens in a slower economy. And lastly, we had a defensive position all this year, and we've maintained that coming into 2023. If you look at the economy, just a couple things. Snapshot, first of all, what happened last year. Obviously, it was nasty. I'm not laughing about it, but I'm just saying it was nasty. And I don't need to say any more about it, but I felt like at Oxbow, we really came through in pretty good shape for that year. We came into the year really defensive, a lot of liquidity. We created more during the year. It helped us out a lot. But there were some things that were positive last year. If you look, for example, the dollar was up. We didn't have a position in the dollar. We did have a position in oil, had a position in natural gas, and we had a position in gold. All of those did a pretty good year last year. I will say on the oils, we've sold most of those in the fourth quarter. We have kept the natural gas side in terms of pipelines, that sort of thing. But and we've upped our gold position as well. But that's how we are coming into this look. If you look at some of the things that are happening in the economy, this is a big number here to look at, which is the Purchasing Managers Index. That tells you all you need to know about, are they buying, what are they buying, what are they bringing in from outside the country, those sorts of things. All of those are going to new lows right now. Now, if you want to look at what really bothers the Federal Reserve right here, this is it, okay? We've been in an inflationary environment, and they've really struck down the money supply, trying to squeeze things down. This is what happened in the 70s, and this is what bothers them. If you look at the first peak here, that was in the 73, 74 era when we had inflation really moving higher. They raised the rates, then they lowered the rates too quickly. This was under Arthur Burns. That was a mistake. You came back, and a year later, you were already at new highs, 2 years later in the inflation rate, and then you had to really get nasty to knock it out. That's what they are afraid of, and really what we're watching as well, because if that happens, you go through another whole round of easy money, things get really crazy again, and then you have to pay the price again. One of the things we're noticing now, though, and you all know this out there, but if you look at food prices in the U.S., UK, Europe, the U.S., we're the best, up about 12%, but food prices really haven't come down that much. That's one of the inflation sides. The other thing that's started to happen now is real estate obviously is backing down. And it's interesting, we used to hear this about 5 or 6 months ago that, hey, don't worry about the luxury homes because they're all paying for it with cash, and so that market won't be affected. Well, didn't work out that way exactly. If you look at the latest Redfin, you'll see that luxury home sales are down about 38%. And we've noticed this all across the country. People that had homes up for sale between, say, 3 and 10 or 12 million, they're not moving. And it gives you an idea of that it affects everybody up and down the line. Now, if you look at the bond markets, and these are some things that the bond market affects, okay? For example, if you look today at how much money you have to make to carry a mortgage, a 7% mortgage, and what percentage of that is, we're all the way back to where we were in 1981, 82, 83, which means that there's so much of your money, average person, having to pay that it really slows down their ability to buy a home. That's one effect of interest rates. One of the other sides of the interest rate side, and you have to look at this graph a little bit closely, but what this means is that most of the time the 10-year Treasury bond pays more than the dividends on the S&P 500, most of the time, okay? But what happened is, you'll see after 09 or 2010, they lowered the rates so far down that the stocks actually, their yields went up higher than the Treasury. In fact, if you look at the peak, almost 85 or 90% of stocks were yielding more than the 10-year U.S. Treasury. Well, you see how quickly that's fallen? And look at the period 1985 all the way up to 09. All of those years, you know, you're talking about 25 years basically, that it stayed flat, meaning that was the norm of that. And we got way out of the norm in this last 10 or 12 years. The next thing we're noticing is this, and this is one of the things we look at closely. We put together this graph, we used it a couple times, but if you look at interest rates declining since 1982, we've been with the winds at our back, with interest rates going down all the way, and notice how that impacted the green line, which is the stock market. And everybody gets caught up on stock picking and how great they are and this, that, and the other, but they always forget to tell you how much wind they had at their back with these lower interest rates, because that makes it a lot easier to make those choices. Let's say that we're going into a period the next 5 to 10 years, okay, where rates don't necessarily go back to that low level. Maybe they don't reach the highs, but they don't go back to the low level. And if they don't, okay, that means we're in for a period much like 1967 or so up to 1983, where you have to really know what you're doing and when you're doing it, because it's not going to be handed to you, you know, with low interest rates. One of the things I want to let you know, the dramatic effect. If you wonder why the bond markets all got beat up this year, I want you to look at this graph. This was a graph of the 3-month to 30-year U.S. Treasury rates now in the green line relative to where they were a year ago. The year ago is the green line, blue line is where it is now. If you look at those two, I want you to look at the spread between those. You'll see how dramatic the rates have gone up in just a 12-month period. That's what's caused all this turmoil in the bond market. The next thing I want you to notice, and this is interesting, if you want to see a really dramatic change, this graph is where you want to look. If you look at the money supply, and we're using M2 year-over-year change basically, it went up for 62 years, okay? You always had more money, more, even during bad times, more money. This year went negative. Now what that means is the coming 6 to 12 months, you're going to be in some credit crises in some areas. If you're going to look at junk debt, companies that are too leveraged in the private sector, you're going to see real estate that's over leveraged. Anything that's over leveraged is going to really start to feel the pinch right here, because money is drying up. Liquidity is drying up. And I'm talking about in the economic system. And when that happens, it causes some really tough runs out there. And that's what I think we're going to see in the next 12 to 24 months. If you look on the stock side, there's two things I want to mention to you that are not in the market yet. Okay, we think they will be though. Number one, we had all-time record high profit margins for the S&P 500 in this past year. 21 was when it was the highest. We think that's going to come back to the norm, and when it does, that means the earnings of these companies is going to go lower. Not only are their earnings going to go lower, but their interest costs are going to go up. Their wage costs are going up on them right now. Everything is going up. Input costs are going up. Earnings are going to come down. And if you look at what the estimate is for everybody on the consensus on the street, Wall Street, for 2023, they're looking at $231 a share for the S&P 500, okay? We think it's more like in the line of 190 or so, maybe 195, but something, you know, $30, $40 cheaper than what that's seeing. All you have to do is put that together and you'll realize that where the market is right now is still not cheap. It's not cheap by any measure you want to look at, because the earnings side's coming down. The other thing that's happening, and let me say this about this graph, okay? This is the Goldman Sachs non-profitable tech. These are companies that don't make any money, okay? And one of the things that happened is between 2020 and the end of 21, you'll see this dramatic increase in all these companies. Made no money. Most of them didn't even have any revenue, okay? They brought more junk from Wall Street in late 20 and 2021 than I've ever seen since I've been in the business. Not just in this area. Obviously, it was in crypto, NFTs, SPACs, the whole thing. But this gives you an idea of what happens when you start to get into the meat of illiquidity and what really goes on when things don't make any money at all. And by the way, I think this year you'll have more companies, public, go under and go to zero and go out of business than any year probably I've been in business, only because they have nothing to offer. The cost of capital is going to go up for them, and it was all a sham to begin with, if you want to get right down to it. And don't get confused by this graph. They did go up. People don't realize, but when you're rising a dollar amount, you can be up 423%, and you come down, the exact same dollar amount is only 78%. That's because from where you start from at the high gives you the number where you're going down to the low. This is exactly, we're right back where we started in March of 2020 on these companies, but they're probably going lower. Next, I want to show you, I mentioned this to you a lot, but this was the last Investors Daily Mutual Fund Index for the year. And if you look here, there's 20 really very large funds here, growth funds. You don't see any pluses up here, by the way, and one of the reasons is for mutual funds, they never carry any cash. They're bragging on the fact now that they've gone from 1.5% cash to 2.5%, and we always laugh at that because, like, what good will that do you in a market that's down 25 to 50%? Basically nothing. Next thing I'll give you an idea, and this is where individuals are today. This is one of the things we notice. They have not gotten to a point to where they are liquidating their stock holdings. What that tells us is this. That means there's more to come. Because if they're down, if you take the S&P down 20, 21 from the top, 35% down on the NASDAQ, and they're still holding in, that tells us that the returns going forward from that are going to be much lighter than they would have been normally because of where people are. If you look at this graph, and this was put together by Chance Finucane, our Chief Investment Officer, and I just pulled a few things from it. You've heard us all year say, look, if you have liquidity, it makes a difference. And where it makes a difference is when you have a low in the market and everybody else is in complete despair. If you have liquidity, you're going to be able to buy things you haven't been able to buy in a long, long time at that price. But you have to have liquidity. If you look at these 4 years, lows in the market, and the average was up 64% in the next full year after that. It's always played out for that for us too. Not because we're geniuses, but if you look at 2003, 2009, those were great years for Oxbow. And the reason they were is because you have to have liquidity at those lows to make a difference. And I'm giving that to you because that's the opportunity for you for holding that stuff that you have in treasuries for the time being. But it will work out in time. I want to say one thing about this, and I won't really linger on it a long time. We talked about it the last 2 years and we got laughed out a couple of times, but this gives you an idea of some of the top holdings in the cryptocurrency field, okay? They're all coming apart, you know, and everybody wants to blow it up. But basically, if you get, past the first top 4 or 5, we're talking about, a digital code that's wrapped around a blockchain. I mean, there's no asset quality here. And you say all you want to, just go look at what's happened to these 9,000 coins, and you'll get an idea of the major losses that people have taken. And most of them won't admit, but it's out there right now. And it's interesting because this always happens. I want to give you a little history here. But in 2000, right at the top of the market, if you'll look at the right graph, New England Patriots allowed CMGI to name the field, pay a lot of money, et cetera, et cetera. Well, obviously, didn't work out for CMGI, and of course that went away, and that's not there anymore. Interestingly enough, we're going to fast forward 22 years, and FTX is down here in Miami doing the same thing, and of course that's going to go away as well. But keep that in mind when you see these things that are on the front of magazines for the first time. And I remember a year and a half ago, 2 years ago, where they they propped up, the ARC funds and that sort of thing, and we're looking at thinking they're probably not going to work, which it didn't. But keep that in mind when you start to see those things come around. So as we go forward, and I just want to leave you with this, okay? There's some things to keep in mind this year. Number one, liquidity, we think right now, is more important right now than it has in any of this period we've been in, because we've probably got another 2 or 3 quarters. We don't know really. We don't have an idea, but we do know this. They'll pay us 4.5% to wait on it with no risk. We do know that. Secondly, we think we're coming into the heart of the negative economic area. And people don't believe it. I will tell you, I talk to people all the time. Well, it's a slowdown, but it's going to turn around. This is the way it always comes around. But we think we're coming right into the heart of when the earnings announcements are going to get worse, their pre-announced are going to get worse, and the prices are going to get worse in time. And you have to be able to be patient and wait through it. I mean, you're not going to miss the low. Okay, you'll be okay. But try to be patient. Don't try to pick that bottom and bottom fish on these companies, that sort of thing. Raised cash levels, which we have. Our cash levels are really high right now. And when I say cash, I mean treasury, short-term treasuries. We are going to stay with that right now. We think it'll pay off as we go through the year. And lastly, be careful of an overzealous Wall Street. I'll tell you why. They will try to get you to enter this market all the while, okay? All the way down, enter, until you get to the end, and then they will turn cautious, which is reverse of what you want to do, okay? And so keep in mind that what you see coming out of Wall Street is not necessarily the best thing for you from a portfolio standpoint. So as we go forward, try to keep your head about you here, because I really feel like these next 2 quarters will be 2 of the primary quarters that are going to really help you out. 2 or 3 quarters maybe a year, but we're not there yet in our opinion. So you've just received our market letter. If not, you can certainly get it. We put it out just in the last couple of days. It goes into more detail on what we're talking about here. But I want to thank you for watching and appreciate it. If you have any information, or if you have anything that you want us to give you information on, certainly come and see us at oxbowadvisors.com. Or give us a call and we'll be glad. But thank you for joining us. We'll see you next time.